Hello and welcome. I'm Real Crowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of Real Crowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our special guest today is Timothy Blair, president of the CCIM Institute and partner with Shannon Walchak, a real estate sponsor focused on primarily Southeast retail properties. CCIM stands for Certified Commercial Investment Member, and its courses, taught by instructors who are themselves industry leaders and practitioners, deliver commercial real estate investment methodologies and tools that speed the pathway between opportunity, a go, no-go decision, and success for an asset. In today's conversation, Tim shares the latest with CCIM and then puts his sponsor hat on to discuss the state of retail. We talked about what types of retail are doing well, which are struggling, and how quantitative analysis can optimize any portfolio's performance. We hope you enjoyed today's conversation with Tim Blair. Well, Tim, thank you so much for joining us today. We're super excited to dig in both on your roles with CCIM and also learn more about what you're up to on the operating side. We had a really interesting conversation a couple weeks ago, and we're grateful that you're taking the time to share it with our audience today. So thank you for coming on.
Great to be here. Thanks.
So why don't you take us a little ways back and tell us a little bit how you got into real estate, and then we can talk a little bit more about what you're up to these days.
Well, yeah, real estate for me is a second career. Coming out of business school, I ended up buying a company out of bankruptcy, turned it around, sold it, got a slight jingle in my pocket, and I swore I would never do that again. And so in looking for kind of my next field, if you would, my next kind of round, I was looking for something that combined analytical skills and financial skills with people skills. And so that's what led me to real estate. And I've always kind of been interested in owning real estate. So for me, a lot of the brokerage and that kind of stuff is a conduit to the investment vehicle of real estate. And so I got into real estate, and a good friend of mine who runs probably the largest landowner in our hometown said, Blair, you really need to go learn how deals work first before you become an investor. And so with that urging, I went out and I just flogged deals for another company here in town, Sloss Real Estate. And for 5 years, I just got dirt under my fingernails doing their deals. And I think that was one of the single best little nuggets of advice I ever could have gotten getting into this industry, to the need to simply understand how deals work.
Mm-hmm. Yeah, I agree. I think a lot of principles started in brokerage, right? And I think a lot of folks that start in brokerage, that's kind of the natural path or the desired path for a lot of folks is you're so close to so many deals and you can see the opportunities, but maybe you don't have the resources to take advantage of them until later in your career. And then you can make that switch over to the principal side. So I know it's a lot of story of a lot of folks that we work with. I know earlier on in your career, and we'll talk a little bit about this today as well, you pursued your CCIM designation. I think you got it a few years before me. I got mine in 2008. I think you said you got yours in 2006, so you got me by a couple years. But tell us a little bit about how CCIM helped you in the early days and your rise within that organization.
CCIM to me says three things. One is it is the pinnacle of commercial real estate education. It's the best education in our industry, period,
Mm-hmm.
Full stop. Secondly, it has community. And I am in a chapter, Alabama, that is very, very active. And so it has provided me an intense sense of community, a very complete kind of ecosystem, if you will. And third, the reason I got into it initially is that when you see the initials CCIM after somebody's name, it says they take their chosen craft seriously. Mm-hmm. It says that they have taken the time to distance themselves from the pack. And so I got my designation in '06 and turned around and got involved with our local chapter a year or two later. And then because it was kind of, for me in my world, it was kind of, I was just dealing with these people all the time. And I became president in 2012 of the Alabama chapter. And that year we won the best chapter in the country for CCIM, something we were very proud of. And then by virtue of that, I got involved with some national committees and started to kind of work up that path, culminating in me being the 2021 CCIM Global President.
And so tell us a little bit about what does that entail? What is your day-to-day with your president of CCIM hat on?
Well, we need to do two primary things. One is we need to continue to drive our education to be the best in the industry. And that means kind of never resting on your laurels. That means evolving the content. It means evolving the methodology of teaching. An example of that would be when COVID hit and everything kind of shut down. We had already been fully online and teaching a multitude of different ways online. So that literally was, while it was a hard transition to go all the way virtual, it could be on demand, it could be instructor-led, it could be some sort of hybrid in between those two. We were already completely up to speed on that kind of content delivery. And so I think it is, number one, to just help and make sure that our education remains at the forefront of our industry. And then secondly, we have 52 chapters. And it is our job to continue to support those chapters in any way possible so that they can play the most positive role in our designees' commercial and in our designees' professional lives. And that could be through either helping provide them with education, it could be helping provide them with community, it could be simply creating scenarios for deals and a higher transaction, because ultimately the primary purpose is to help people earn more money. And so those are kind of my thing, is to help those two primary areas, education and chapter benefits. And then another realistic kind of small thing is I'm that guy that flies in the night before, attends the cocktail party the next day at the market symposium, speak for 10 minutes, and then I kind of head out the door. So this year I refer to myself as I'm that guy.
You're that guy. Well, congratulations on being that guy. And then now switching hats a little bit, tell us a little bit about with your operating role in the day-to-day on the real estate side, and then we'll dig kind of back into some of the nuts and bolts of the CCIM curriculum.
Shannon Walczak is a Birmingham-based company. There are 4 partners here, me and 3 others. And from the outside, we look like just another kind of local real estate company. We have 8 or 9 kind of full-time third-party agents who live off the land. We have a property management arm. We manage about 3.5 million square feet, and we have guys in trucks. And then we have an investment arm also. And it's the investment arm that I think is what is our special sauce. And because what we really love doing, we as a company, and then we the 4 partners, what we really love doing is putting deals together. And we'll find a property, and you put together investment groups and put them together. Over the last decade, we have probably done 80 deal-by-deal transactions. I may touch on this later on. About 4 years ago, we started our first fund. We are currently in our second fund right now. And so to describe our company, I'd say we are a retail-focused company. Probably 2/3 of our portfolio is retail. And then what we believe, our ethos, is you earn your living through brokerage, but you build your wealth through ownership. And we encourage our employees, we encourage our brokers. We are huge proponents of owning real estate as a method of building wealth. Now, you got to be careful with it because it can bite back, but we are huge believers in that.
I agree. I think that's what we all love about the asset classes. It's one of the greatest wealth creation tools there is out there. So I think we're on the same page there, and I think a lot of the listeners would agree as well. So I think, with an eye towards our listeners, most of whom are passive real estate investors, high net worth individuals that are looking to invest in real estate, some service providers tangential to the industry brokers, managers themselves. Why don't you walk us through the core CCIM certification? What does it mean when you get that designation? What is the process to get that? And who is it really for, I guess?
The CCIM designation, which stands for Certified Commercial Investment Member, is a certification, a designation, actually, it's a designation, that in order to achieve only probably 6% of all commercial practitioners will actually get the CCIM designation. And that's because it's hard. You got to put in a lot of time and effort. You got to want it. And it is 160 to 180 hours of classroom material, and there are portfolio requirements. So you have to transaction requirements. You have to be able to prove that you've done certain volumes of deals. So it's not just an intellectual knowledge; it's also a practical knowledge. And then after that, and it usually takes our people 3 to 4 years, plus or minus. Mm-hmm. And then after that, you get to take a 6-hour test. And if you take all the classes and pass the test at the end of those classes, you can produce a qualifying portfolio, and then you can pass the final exam. You are then a CCIM. And I will tell you, I penned a lady earlier this year, about maybe 2 months ago. It was one of the most emotional experiences it meant more to her. Oh my goodness, she was crying, I was crying. It was just downright special. And that's the place we hold in our members' hearts, that you really do have to work at this. Now, as an investor, why do I care? So what? Well, when you see someone with a CCIM designation, what that means is that A, they do care enough to separate themselves from the pack. But more importantly, that they know how to, in my words, rip a deal apart, understand all the components that are in it, and then put the deal back together again. They are not taking any information for granted, that they can dig into any component, any part of the analytical side of a transaction and the valuation of a property. And they know how to rip it apart, look at each component, evaluate each component, change the assumptions if need be, and then put this thing back together again. And that is what you get with the CCIM. It is a very unemotional kind of just way to evaluate and analyze real estate. Because at the end of the day, real estate is a financial transaction, and we just want to understand the components of that.
Yeah, and I think I will caveat the 6-hour test sounds pretty brutal, but if you plan it correctly, you might be able to go to Hawaii as I did to take it in Hawaii. That made it a lot more palatable. I'll be honest with you.
That's the way you do it.
That was a good one. That was a smart decision. So the core curriculum, and I'm sure it's, as you said, it's always evolving. Financial analysis, market analysis, the user decision analysis. So, if you're leasing one property versus another, buy versus build kind of a thing. And then a little more in-depth kind of investment analysis. Has that remained consistent, or are there new courses to it, or how has that curriculum changed over the years, or what are some of the newer things that have maybe been added to that core curriculum?
I'm going to answer that two ways. One is the core curriculum has remained the same, and it's because there are just some basic principles that no matter how the industry evolves, you still need to do investment analysis. You still need to be able to do user analysis. Is it buy versus rent versus buy, lease versus own? The IRR components and how do I run those? So the core components have essentially stayed the same. Those plus negotiations and an ethics class. Where we have been able to really flesh out some additional content has been through what we call the Ward Center. Mm-hmm. And over the last several years, we have added 80 classes to the Ward Center. You don't have to be a CCIM to take them. And they cover just a broad array of commercial real estate topics, things that are kind of unique or pertinent to our day-to-day world. For example, one that I love And it just sounds as dry as it can be, but it's fascinating if you do this stuff every day. And that's IRR. IRR is one of those things that you can manipulate the heck out of it if you want to. And there are some components of just the traditional IRR that can create or could shade the answer in a certain way. And so then they have XIRR, and you have some other things, because in an IRR, it always assumes kind of a constant reinvestment rate. And that real world speaking, that's just not the case. Mm-hmm. And so the Ward Center, in this particular class talks about those specific things. And so the Ward Center is a place for classes like that are unique to our industry and are applicable to every practitioner, whether you're a CCIM or not.
Yeah, and that's really interesting. And I would also say too, a lot of folks, if some of those classes, if you have basic financial analysis, right, you don't have to commit to the full course of being a CCIM to take CI 101, for instance. If there's some of those classes that look interesting, and certainly through the Ward Center as well, there's a lot of really good content and education, and that's so much of what we do about this podcast, right, is helping people understand different ways to look at the analysis, put their critical thinking hat on when they're looking at real estate investments. And again, I think there's a lot of really, really good resources within CCIM that we'll put links down in the show notes for anybody to take a look at what some of those classes are. I think, again, just phenomenal resources for people that are interested in learning more about the nuts and bolts of real estate, as you said, being able to understand the components of what makes a deal, and then thinking critically about those, right? And that was so important for me, early foundational in my career, was to have that education about this is how these things work, this is why we look at it this way. And that's been, that's stuck with me for the last 16, 17 years now. So I'm a huge fan of the CCIM. Again, would wholeheartedly recommend listeners, take a look and see what courses interest you, and sign up for a couple. It'll certainly be money and time well spent.
You make a great point, and that is, to my mind, and I am clearly a biased person on this topic, there is no reason in the world that someone who is new to our industry should not take at least 101. Because it is kind of like the Cliff Notes. And the special sauce with CCIM is that our classes are taught by practitioners. So that your instructors will have been doing a deal the week before. They're probably doing deals in the back room when you're working on something, and they're going to be doing deals next week. And that's the people that are teaching you this content. And there is simply, I cannot think of a reason why somebody would not at least take some of these classes. It's just a jump start. As I heard one person last month in Florida refer to it as them strapping rockets onto their career. And I just thought that was a great kind of imagery.
Well, maybe after the show we can chat about maybe we can sponsor a couple courses and have some educational content for all the listeners out there. We can maybe figure something out there to get our audience some access. So let's switch a little bit to the operating side again. As you mentioned, CCIMs are practitioners, and so with your operating hat on, we wanted to dig in on the state of the retail investment world right now. Certainly over the last 18 months with the pandemic, and even in the lead up to that, there was a very strong narrative that retail is dead. Amazon is just going to clean its clock. Malls are dying. The whole bricks and mortar just isn't going to be a thing anymore. So I think there's a very broad assumption that all retail is created equal in the eyes of bigger stories and driving eyeballs to news stories. So why don't you tell us a little bit about what you guys are seeing on the ground in the retail space, maybe what areas you focus on, and how the last 18 months really played out for you guys, given your seat at the retail operating table?
Well, for us, I would break the retail world, and you touch on a great point, and therein lies the opportunity. I would break the retail world in basically three buckets. You have malls, which is what people generally tend to think of when they think retail. And malls are they're undergoing their own thing over there. And ultimately, probably a third will survive and 2/3 should be bulldozed and kind of just transitioned into something else. For example, there's one that I pass every night on my drive home, which has been torn down and is now an Amazon last mile fulfillment center. And so that kind of class over there is going to be transitioned into something else. And just as 50 years ago, retail transitioned from urban environments to the suburbs, which are kind of represented by the indoor shopping malls, they are now transitioning into the next thing. The second bucket I would call would be the power centers, the big outdoor shopping centers with full of the big boxes. And with that, there was already transition at play there. They sell hard and soft goods, and those are the people that are getting hit hardest by the internet. And it's just a fact. And so they were kind of, busy struggling, trying to figure out, you can have a 60,000 foot box that wants to figure out how they can live within 35,000 feet. And so what the pandemic did to them is it simply accelerated an underlying trend dramatically. And so whatever impact the pandemic has had on power centers was already at play. It just got accelerated. Now, one fact to hang on to for those that are crying that retail as we know it is now dead or is going to die is that clicks and mortar beat clicks and it beats mortars. And that's as evidenced by Amazon this past week taking two Whole Foods stores and converting them to that system they have where you just pick up something and walk out with it. It's a cashierless store. I haven't seen one yet. But that is, kind of to point to as clicks and mortar is the ultimate thing that everybody's shooting for is how do these two things work together and what's the perfect equilibrium of those. And so what the internet has forced is for traditional brick retailers to really up their game and get better at this, or else you're not going to survive. And so you go through you go through the pandemic and you got a bunch of these big power centers around there. And the fact of the matter is you can probably make some money buying power centers right now. The brokerage world is going to make money helping all these leases kind of get redone. And it sounds easy reducing some big box store from 60,000 feet to 35,000 feet. It's not. You just can't divide the space in half. That's expensive. So they're going to have to move to another space. And so there will be some real business to be had in this. But as an investor, it's going to be you could probably make a pretty good return with power centers because you're going to be able to buy them cheap right now because of all of the chaos in that sector. But it's going to be a painful thing betwixt here and there. And so the reward will be there financially, but the operators are going to have to be really good at what they do because it's going to be a long, hard slog. And the second thing behind that is that what is the real credit quality of the large retail tenants? I think there's some real credit players out there. I also think it's just something you need to be careful and be very intentional about when you assume that a credit tenant is in fact a credit tenant. The third bucket, if you will, would be what we call service centers or neighborhood centers. And those are where we tend to play. And it's just what we know. And that would be the unanchored neighborhood centers. And they are primarily service providers. They, think of the one near your house is what I tell folks. Think of, the Mexican restaurant, the local PT guy, the dry cleaner, although there are less and less of those. The dock in a box would be in there. The UPS store would be in there. They are service providers to people. And that, heading into the pandemic, I would have said their primary value draw, if you will, or value prop was that they were internet resistant, that stores in these centers need people. You have to come in to do it. You have to come in to get your nails done. You have to come in to get your hair cut. You have to come in for your physical therapy. The second thing that has come out of this is that these tenants were remarkably resilient during the pandemic. And that is not something that was obvious at the front end because it was the restaurants, it was the things that people had to come in to do. Those stores were forced to shut down. And what happened was that they learned how to do it on carryout. They learned how to do more with less. And so they adapted. And the truth is that while if you look at some national graphs on accounts receivable, which is a good kind of tell on who's paying, it's not a good tell, it's the tell on who's paying their bills, who's paying their rent on time, et cetera, is that the national retailers, when the pandemic hit last March, just stopped paying people.
Right.
And I know that, I have some friends that own power centers, and they were getting all these nasty grams from national tenants, basically saying, I'm never going to pay you again until I understand what's going on. And because in their mind, they held the leverage that they were going to tell the landlord how it's going to be. What happened with the mom and pop, with the strip centers, which were the neighborhood centers, which are mostly full of small, locally owned mom and pops, is that they continued to pay. And that if you look over a 12-month kind of a period for AR in the pandemic, the strip centers or the neighborhood centers had a far higher collection rate than the power centers with national tenants in it. I mean, it was. I saw an Amazon guy speak about that. Was just one of the really interesting things to come out of the pandemic was the strength and the durability of the mom and pops.
Yeah, and when we were talking again a couple of weeks ago, I think your comment on how it really renewed your spirit in entrepreneurism here in the U.S. I thought that was such a refreshing take on all the doom and gloom that we heard about how bad it was out there. Maybe you can share some of the stories about that. I just thought that was such an awesome outlook on your front row seat at working with a lot of the tenants. I mean, how many tenants were you guys working with? How did you help them through that? And what was the downstream effect of that? Working all the way down to lenders and from your position as the owner?
Two little stories I'll share with you. We deal with about 400 tenants, and so when this thing hit, I mean, we were all deer in headlights for the first week or two. I liken it to the Tower of Terror at Disney World. You're just hanging on to this thing, and it's shaking up and down. And for the first week or two, you are just literally hanging on, trying to figure out, okay, when is this thing going to stop moving, and I can start to kind of just get my head screwed on straight. So what happened there was we deal with about 25 financial institutions. And so about towards the end of the second week of the pandemic, the Fed issued an edict, if you will, or kind of told the banks and the financial institutions that in fact, that if loans could go 90 or 120 days without paying, and the banks didn't have to reclassify them. And I may not be saying it exactly right if there's a banker who's on this, listening to this, but you kind of get the gist. Is it the Fed gave banks some leeway to cut borrowers some slack. And why is that so important? Well, it's so important because as a landlord, I can't turn around and start giving out benefits to my to my tenants who are struggling if I know the bank's going to turn around and beat me up on the other side. I couldn't get caught in the middle. And for a couple of days there, I mean, that was abject fear that we were going to get caught in the middle of this thing. So the banks allowed the landlords some flexibility. So that thing came down on a Friday afternoon. By Monday morning, we had a couple of emails already in our system from banks saying, okay, I've got these X number of loans with you. We're going to give you some grace period to figure things out with your tenants. So what we did was we got grace on different levels between about 21 or 22 of our banks. So we then pivoted and started cutting deals with our tenants. And we broke it up into groups. So every single tenant, we were able to kind of address individualized needs with every single tenant. And we ended up cutting deals with about 100 tenants. And we would offer them deferral of sorts so we could kind of just help figure out exactly where they were. We required that they do some very basic things in order to, before we'd even talk to them, they had to provide us financials. They had to give us some sort of proof that they had applied for PPP, et cetera. But what we were able to do is then turn around and do a bunch of deals with our tenants, because the truth is we were in this thing together. Mm-hmm. It was us versus the world. And that sounds a little silly, but it really was. We were all just trying to figure out how to live to fight another day. And there were kind of two things that drove, one that drove that home to me, and then the second one I'm going to share with you about kind of just my that was just gives me great hope and optimism for our future. One is one of the deals that I was QB on, and I was kind of talking to the tenants. It's this little restaurant that had just done fabulous. And so this is a mom and pop restaurant. Really, they just were slaying it. They'd only been open about 5 or 6 months. It was their first restaurant. I had eaten there a couple of times, so it's here in town. And, it was just talking to this woman, you could just, the fear, it was everywhere in the conversation, because this was her dream. This was their life savings that was tied up in their restaurant, and they couldn't open. And, the margin for error was remarkably thin. And so we gave them some extra time to just kind of, just don't panic. And anyway, inadvertently, the rent is paid with an ACH payment, which means every month that the rents just get swept out of their account. And it was supposed to, I thought, it was supposed to have been delayed a couple more days than it was, or I communicated it wrong to her. So anyway, when I am working with this woman, her rent got swept. And because of that, a check or two bounced for her. And just the pain and the agony in her voice. And you could just understand how close to the margin this woman was operating. And they had been, again, quite successful. And you knew they were good at what they do. It drove home to me the real price of this whole thing, and the role that we play in working with our tenants and helping them survive. That somebody is just one rent payment away from, oblivion. Mm-hmm. It really humbled me greatly. It pained me, and it also screwed my head on straight for who I was dealing with and how I needed to help and approach these folks to make it through this. So that was a story that really kind of helped me understand the stakes that are at play. The other one, so then fast forward, call it another couple of months. Over the course of the pandemic, and in my mind, the pandemic is like from March of 20 to March of 21. And I know technically we are still in it, and my goodness, I'm not sure when we'll get out of it, or what, if we do, what that looks like. But for that 12-month period, we lost 11 tenants and we added 9. And the amazing things to me is that we were leasing restaurant spaces to people in the middle of the pandemic. And talk about optimism when you are doing a lease deal with a tenant who cannot have people come into their restaurant and eat. And their absolute faith, their absolute optimism and confidence that they could make it work. I mean, so to me, the fact that people were out there in our centers and all across the country opening up businesses in the middle of the pandemic is just a testament to the American can-do spirit, the entrepreneurial drive that I can do better, that I want to achieve more. And I just got to say, if that does not give you hope and optimism, then I don't know what will.
Yeah, that's great. Like I said, it's just such a refreshing take, and all of the, it's so easy to get swept up in the doom and gloom of everything we went to hear your experience of seeing that firsthand. I think, again, it's just it is inspiring to know that it is still alive here, and that there's people out there that have a pretty good bucket of hope for where we're going. So it's, again, thank you for sharing those stories. I enjoyed hearing them, and hopefully our listeners enjoyed hearing them as well. So thinking a little bit about back to the deal side, I'm curious, what is the landscape for deal flow right now? We've talked a bit on the show about how the assumption maybe Q3, Q4 last year was that there's going to be a significant amount of distress and there's going to be a lot of really opportunistic buying. which I don't think we've really seen materialize. So I'm curious, what is the deal landscape looking like out there? And have you guys, are you looking at things differently now? Have you changed any of your underwriting criteria? Is there anything that you're paying closer attention to now, given what we've learned over the last year and a half, year or so?
Of course. Yeah, there is. I too was expecting a bunch of distressed real estate the latter half of last year, and it just never materialized. And I think that's a testament to the PPP working. I think it's a testament to what I just mentioned about earlier, that people simply, mom and pops don't know quit. I mean, it's either 0 or 1. They're either open or they've lost their life savings, and they will literally fight to the death. The truth is that there is a ton of dry powder on the sidelines. And so there is money all over the place seeking deals. And with low interest rates, I think deal flow right now is remarkably good. I think pricing is very high right now for certain product types. And I think you've got into a backdrop of, with potential governmental action on elimination of the 1031s, cap gains tax going up, you are seeing people enter the marketplace just for those reasons. I think that you are seeing kind of just normal deal flow. I think you're seeing deal flow because, like I said earlier, the interest rates are so low. There's just an easy access to money. So all to say that I think that right now, it's surprising the number of brokers I know who last year had their best year ever and are on track to do so again this year. The real estate sector right now is wide open. Now, I made that comment one time in New Orleans, and they all looked at me like I had two heads, because New Orleans had been absolutely slaughtered because they're a hotel, they're a tourist destination. So Orlando, Las Vegas, New Orleans is clearly not a place to say that. I learned my lesson on that one. But the truth is, a surprising number of brokers have had really, really good years during this pandemic.
And so it sounds like deal flow is still robust. What are you guys looking at differently, or are you looking at anything differently now, given what we've learned through the pandemic?
Yeah, thanks. What we do is we underwrite. Underwrite more conservatively. I think that's kind of an obvious. We will now probably be very skeptical of having too many restaurants in any one center. You always had to be careful of that because restaurants will tend to chew up your parking. So we will need to be careful about the number of restaurants that we have, and that would probably, for what we're looking at, that's probably our single biggest takeaway.
Mm-hmm. And well, maybe that's a good dovetail into this how you've been able to combine the work with CCIM and with your operating hat on. You told us about a little bit of some quantitative analysis that you did within your own portfolio to help crystallize your strategy going forward. And maybe you can share with the listeners, because as we talked the other day, I think it's a lot of outside view of how real estate works is there's a lot of kind of gut feel and relationships and kind of black box magic stuff that happens that results in this acquisition opportunity. I thought it was really interesting how you took a more analytical approach to your own portfolio to help guide maybe what some of those criteria are going forward. So, without giving away all of your secret sauce, would love if you can share how you guys put that analytical hat on and some of the work that you did with CCIM in researching what it was that you guys found.
Well, we are real estate guys, and we come at this from the ground up, and we all cut our teeth in brokerage just doing deals. And so, you then fast forward that, 10 years, and we've done all these deal by deal transactions, and you have, call it 70 or 80 properties in your portfolio. And so 4 years ago, we wanted to grow geographically. And a real estate company can grow one of two ways. You can either become just a bigger you, a new you in a different city, or have product type will travel. And the real estate by definition tends to be local. So us becoming just a new us in another city struck us as a very hard, unlikely way to grow. Having product type will travel is how many people do it. So I retreated and I kind of just looked into our portfolio, which was just kind of a bunch of deals we'd done over the prior decade, sincerely looking for kind of what's the common denominator. And so what we do is we probably owned 30 to 35 neighborhood centers already were in our portfolio. That was clearly our core competency. And then I looked at it, looking over the returns of all that certain property type. Some of the centers just did, over time, just always stayed full and always posted very good numbers. Some of the centers did okay, and then there were a couple of dogs that you wish you'd never heard of. And so with a very kind of open and sincere mind, my question was, well, what's the common denominator of the centers that did well and the ones that didn't? So with my CCIM hat on, some folks at CCIM helped me create this massive spreadsheet. And what I did was I took 7 centers. I took 3, you're going to have to pry them out of our cold, dead hand. We love them so much. 3 centers that are solid producers, and then 1 dog that I wished I'd never heard of. And so I put those 7 centers across the top of the spreadsheet, and then we literally ran 70 lines of demographic data underneath it. And we were looking for what is the commonality of the winners and the losers. And when you go through that whole process, it was deceptively obvious what the answer was, but I liken it to you have to walking around the block to kind of figure out where you started from. And for us, it's density and affluence. That when we buy unanchored neighborhood centers in neighborhoods with certain levels of affluence and certain levels of density, good stuff just tends to happen. And the way we define that, so what happens is when you do that, you can then hang real numbers on it. You can hang very specific numbers on it. So for us, the way I would quantify it is within a 1 mile ring, not 3, not 5, but a 1 mile ring, because we live and die in our little immediate neighborhood. You have an average of 70,000 household income or greater. You have 30% bachelor degree or greater, which is kind of a corollary of the income. And then you have 8,000 daytime density or greater. And what happened is that when we kind of can buy centers that are in neighborhoods that those numbers represent, they just tend to stay full. And the way I process that is that when the Mexican restaurant blows out, the Chinese restaurant blows in. When whatever the fad was, exercise fad was, 5 years blows out, the new fad blows in. You benefit from medicine now wants to be closer to the rooftop, so you can have the medical people kind of starting to come in and backfill where maybe the cleaners used to be. What you're banking on is simply there is a desire to be near affluence and density. Mm-hmm. And so you do still have some turn in these properties, but when you get an opening, somebody else is fairly quick to fill it because they want to be near that affluence and that density. So that's how we defined it. And so what we did was we then built a strategy around it. And that was the kind of the core thesis of our Shannon Walchek Neighborhood Center Fund 1, and it's the same core thesis of our Fund 2, in that we are buying unanchored strip centers throughout the Southeast and the Midwest in certain neighborhoods that meet certain levels of affluence and density.
And like you said, it makes sense, right? I mean, that's what tenants want, right? You have to almost look at it through getting back to that user decision analysis, right? When a tenant is looking at their options of where they can locate for a new business, they're going to want to be in the most desirable proximity to both income and households, right? I mean, just like you said, it makes sense. And I think that's wonderful to be able to take something that from the outside can be so complex and look at a fairly easy heuristic to understand. How much of that is combined with the art of, you said you're a deal guy. I think most folks that started out in brokerage, once a deal person, always a deal junkie. How do you combine that analytical approach with still some underlying art of real estate analysis and neighborhood analysis?
I refer to, I think of it, it's like a telescope, or if you're looking at a map, you can say, okay, we want to be here, here, and here. If you're looking at you get all these flyers and you look at it and you can quickly kind of telescope in to say, okay, I like that neighborhood. That neighborhood suits me. Then you go back to your real estate 101 and the dirt under your fingernails. Do I like the tenant mix? How does it sit to the road? What condition is the property in? Is there deferred maintenance? I can't remember if I said curb cuts, but then you get back to just your basic real estate stuff that in terms of, how do I like this center? But what you do is you kind of confine the neighborhoods or the rings that you're looking at the center in to only those ones that you want to be in. Make sense?
Yeah, absolutely. And again, that's where just that experience, right? Cutting your teeth and getting back to the fundamentals is still where we end up, which is...
and you can't... I'm sorry, you can't replace boots on the ground.
Right.
You have all this technology and you have Google Earth and you can just do all this stuff from afar. And so it dramatically accelerates your picking the right neighborhoods and whatnot. But at the end of the day, you have got to show up, walk the dirt, see, just see how it feels and how it looks. And you got to touch it and just see how it sits to the road. And then talking to the tenants. You always got to talk to the tenants. And you'll know how a center is doing by talking to the tenants.
Wonderful. Now, kind of switching this to the lens of, again, the bulk of our listeners being investors, passive investors in real estate, how should they be thinking about retail as an investment asset, in the asset class right now?
All retail is not created equal. Mm-hmm. And I would think of it as how to take advantage of the bad headlines. And there's a dislocation that has occurred. And that I say retail, and people's minds go to, ghost malls and the power center that has 4 vacancies where, the 30,000 box used to be. And also this retail that has been slaughtered and decimated by the internet. And that's what people's minds go to. And so I would say, how do you take advantage of that? And the truth is, the service centers, the neighborhood centers that we are investing in have kind of gotten caught up in that merely by the description that they have retail in their title. But the truth is, they're service providers. They are service providers of all those things that I've talked about before. But they kind of get lost in this big world of retail. Mm-hmm. And so that would be my advice is that when you see an entire kind of broad swath being kind of, whitewashed with one description, there's always going to be some room in there. There's going to be something that necessarily doesn't fit that. And so I would say our segment is exactly that.
And so as investors are looking at some opportunities out there, what are some questions that they should be asking either to the sponsor if they're looking at buying one on their own, to maybe the broker that's helping them buy it, or the selling broker, and what are some of the red flags that are things that people should look out for as they're looking at retail assets now?
And I will answer in a deceptively kind of simple way. I would want to look at the track record, and do the sponsors, the people that I'm contemplating dealing with, do they pass the smell test? Are these folks that I want to deal with, and how have they done in the past? And so I would say that what happens is when I go out and I'll talk with people, and they'll say, well, I was getting X% return for this thing, because people tend to be, I just want the highest possible return I can ever possibly get. And I get it. But the truth is, you need to understand you took a risk to get that. And that the market, that there is a risk and reward. And so for every deal that offers you a high return, people need to understand they're getting that return because there is a commensurate amount of risk. And then for more solid, more stable deals, you use the money that, that you do the capital preservation plays, the core and the core plus. But, the truth is, people, you just need to understand that there is no free lunch. You do not get to have a disproportionately high return without taking a risk. And so that would be kind of my, you just need to understand in what you're looking at, and evaluate kind of what they're doing for yourself. If it seems too good to be true, my guess is it is.
Mm-hmm. Perfect. I think that's a pretty succinct way of summing up the landscape out there of investment opportunities. So as we look to wrap up here, Tim, again, you've been so gracious with your time. Really appreciate the insights and stories you've shared with us. We like to ask our guests at the end here, what are the things that are keeping you up at night? And second to that, what has you most optimistic right now about where we're at and looking forward?
We take people that have entrusted our money with us very seriously. I mean, we are humbled and honored that people trust us. And that is the single most important thing to us, is that we are good stewards of those funds. And the way that translates into reality or day-to-day for us is that what keeps me up at night is that we aren't keeping the centers full. I mean, the single most important thing we need to do is keep our centers full. And so that is the single most important thing, I would argue, for us, is we keep the centers full. And we stay ahead of the any potential turn that's going to come. We have an answer. We have a plan when they do come, because it does just happen. You've got to be a very, very capable operator in order to make this work. Then what has me optimistic is what I touched on earlier. I think the American can-do spirit for bettering your life through business ownership is just the coolest thing ever. I think it is what makes us special, and that is what really gives me hope. We will figure a way through this. Throw me the hardest thing you got at me. We'll figure our way through it. Mm-hmm. And so I just saw mom and pops, husbands and wives opening up businesses, when everything said don't, and they still did, and they made it work. And that is just cool stuff.
Couldn't agree more. I think that's a great outlook. Well, Tim, how can listeners learn more about what you're up to, both with CCIM and with your operating hat on at Shannon Walchak?
For CCIM, just go to ccim.com and check out all of the classes that are offered under the Education tab. There is the core product that we were talking about earlier, those classes, the CI 101, 102, 103, and 104. And I would encourage folks to think about taking 101, just because it's a great class in just ripping properties apart and putting it back together again. And then for Shannon Walchak, I would go shanwalt.com. Our company is Shannon Walchak. We're out of Alabama. Orange is our color. And on our webpage, we have a tab for our funds if interested in learning a little bit more about that.
Perfect, and we'll have links in the show notes for listeners. Again, couldn't recommend checking into the CCIM any more than we have already. I think it's a phenomenal resource for people that are interested in learning more about the fundamentals of how these investments come together. So thank you so much, Tim, for coming on, sharing all that you did with us today, and we really appreciate your time.
All right, take care. Thanks.
All right, listeners, that's all we've got for today. As always, please send us a note with any comments or feedback to podcast@realcrowd.com. And with that, we'll catch you on the next one.